Covered bonds and securitisations are easily confused. Both rely on security over a pool of assets to create bonds, usually with very high credit ratings. In both cases, the underlying assets, more often than not, are residential mortgages, but both also fund other assets as well. Some people say that covered bonds are like dual recourse securitisations. If the assets securing the bonds don't generate enough cash flow, investors have recourse to the issuer as well. But it's a bit more complex than that for reasons that we're going to explain over the next few minutes. Let's start with issuers. Why would an issuer choose one instrument rather than the other?
Historically, securitisations have transferred most of the risk of the assets not performing to investors. If the assets don't pay, neither do the bonds. In addition to the senior notes secured on the bonds, usually with a AAA rating, they have issued subordinated notes with lower ratings to fund more and more of the asset's value and take on more and more of its risk. By shedding risk like that, banks have been able to reduce their need for expensive risk capital. Some banks went too far before the financial crisis, so many regulators introduced rules that banks could only transfer some of the risk of the assets and had to retain some exposure, typically the first 5% of losses. Covered bonds, on the other hand, transfer no risk from assets to investors. If an asset goes into arrears, the issuer usually has to buy it back. That makes them safer for investors, but means they can't be used to manage risk or avoid having to hold capital.
Apart from the transfer of risk, how do the instruments differ from an investor perspective?
One of the implications of the closer link between the bonds and the assets is that in securitisations, the bonds usually pay down when the assets pay down. If someone repays their mortgage early, the bond secured on it amortises a little. In a covered bond structure, if someone repays their mortgage, the bank just uses that incoming cash to buy new mortgages and keep the bond size constant until its scheduled maturity date. Those contrasting payback arrangements, amortising and bullet maturity, lead to the most often overlooked difference between the asset classes. Securitisations are usually floating rate and prepayable. Covered bonds are usually fixed rate and fixed maturity. Of course, there are exceptions. Some securitisations are fixed rate and pass repayment risk to investors. Some covered bonds are floating rate, but they are the exceptions, not the rule.
How safe are they? How did they perform through the financial crisis?
Covered bonds performed exceptionally well during the crisis. Over 20 banks who issued covered bonds failed during the financial crisis, including big names such as Dexia and Northern Rock. But no covered bond defaulted. Every interest and principal payment was received on time, in full. What's more, the number of credit rating downgrades was relatively low and was usually caused by external factors, such as the sovereign rating ceiling, rather than anything wrong with the bonds.
Which leads me neatly on to my next question. How do the laws and regulations differ between the two products?
This is another one of the big differences. Securitisations are typically structured mainly according to contract law. Only a small number of countries have actually passed an Act of Parliament to establish the instrument. In contrast, most covered bonds come from a country where legislation is used to define the instrument. Part of the reason for this is that under European Union law, countries have to put in place special public supervision designed to protect bondholders. Many investors consider that a key difference between securitisation and covered bonds. At the European Union level, both instruments have recently had directives passed. These mainly define the way that bonds are structured if investors want to treat them in certain ways. One of the more controversial aspects of this is that the securitisation market thinks that their treatment is too harsh and the treatment of covered bonds too lenient. That's an age-old debate.
So that's the issuer, investor and regulatory aspects covered. Are there any other differences?
One of the biggest is that covered bonds can only be backed by a narrow range of high-quality assets, mainly mortgages and public sector loans, while securitisations are used for a very diverse range of assets. Then there are the different players in both markets. For example, not many investors are active in both asset classes, and investment bank league tables look very different. Even the market cultures tend to be different.
If you would like to learn more about the securitisation and covered bond markets or have any opinions on what we've said here today, please join us at one of our forthcoming conferences to join the discussion.